Before we begin, a quick and important disclaimer. The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. Divorce insurance is a complex, highly specialized, and often unavailable product in the modern American market. The discussions regarding behavioral economics, historical insurance models, and statistical trends are intended to provide academic insight into how risk is managed in the United States, and are not recommendations for any specific financial strategy. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified legal and financial professionals, such as family law attorneys or certified financial planners, before making any decisions regarding their marital or personal finances. Statistically speaking, nearly half of the people watching this video who are currently married or planning to be married will eventually face an event that is more financially devastating than a total house fire, more expensive than a major medical crisis, and more complex than a corporate bankruptcy. We are talking about the dissolution of a legal marriage. In the United States, you can purchase insurance for your smartphone, your pet, your identity, and even your fantasy football league. Yet, for the single most significant legal contract you will likely ever sign, a contract that effectively merges your debt, your income, and your assets with another person, there is almost zero traditional insurance coverage available. This is the ultimate paradox of the American financial landscape. Why is it that in a country obsessed with risk mitigation, we have failed to create a sustainable market for divorce insurance? Today, we are opening a deep dive investigation into the behavioral economics of heartbreak and the failed history of marriage insurance in America. We are going to look at why your brain is biologically programmed to reject the very protection you might need, and how a small company in North Carolina once tried to change the way we price the risk of "until death do us part." By the end of this masterclass, you will understand the hidden financial architecture of the American family, and why the optimism bias might be the most expensive cognitive distortion in your portfolio. To understand why divorce insurance is not a standard feature of the American insurance market, we first have to look at the sheer economic weight of divorce. Historically, trends suggest that a divorce can lead to a 30 to 50% drop in the standard of living for the lower-earning spouse, while simultaneously triggering massive wealth destruction through legal fees, the forced liquidation of assets, and the loss of economies of scale. In the U.S., the average cost of a contested divorce can easily climb into the tens of thousands of dollars, often acting as a wealth tax on the middle class. From a behavioral economics perspective, this represents a massive unhedged risk. In any other sector of the economy, a risk with a 40 to 50% probability of occurrence would be met with robust insurance products. If there were a 50% chance your car would spontaneously combust, you wouldn't just buy insurance, the government would likely mandate it. So, why doesn't divorce insurance exist at scale? The answer lies in two critical concepts: adverse selection and moral hazard. In the insurance world, adverse selection occurs when only the people at the highest risk of a loss buy the insurance. If only people in failing marriages bought divorce insurance, the premiums would have to be so high that the product would be unaffordable. This is where behavioral economics intersects with finance. Most people entering a marriage suffer from what researchers call optimism bias. When surveyed, nearly 100% of couples getting married believe their chance of divorce is zero, despite knowing the objective national statistics. Because the low-risk couples refuse to buy the insurance, the pool becomes skewed toward high-risk individuals, causing the market to collapse. Then there is the issue of moral hazard. This is the idea that if you are insured against a loss, you might be less careful to avoid that loss. Critics of divorce insurance argue that if a spouse knows they have a $50,000 payday waiting for them upon the signing of divorce papers, they might be less inclined to put in the hard work of marriage counseling or reconciliation during a rough patch. However, historical case studies, such as the Safeguard Guarantee Corporation, which launched in 2010, tried to solve this with a vesting period. You couldn't just get married, buy insurance, and divorce the next month. You had to pay premiums for years before you could collect a single cent. This was designed to ensure the insurance was a safety net for those who genuinely tried to make the marriage work, rather than a get-out-of-jail card. Safeguard, led by entrepreneur John Logan, introduced a product called Wedlock. It was structured not as divorce insurance, but as marriage indemnity insurance. The concept was fascinating. You would buy units of coverage. For roughly $15 to $20 a month per unit, you would secure $1,250 of coverage. The catch was the 4-year waiting period. If you divorced in year 1, 2, or 3, you received nothing. This was a direct application of behavioral economics meant to weed out the adverse selection participants. They also offered stay marriage bonuses, where the value of the units would increase the longer you stayed married. It was an attempt to gamify marital longevity through financial incentives. Despite the innovation, Safeguard faced massive hurdles. First, there was the social stigma barrier. In the US, marriage is viewed through a romantic lens, not an economic one. Suggesting divorce insurance at a wedding is often seen as a prophecy of failure, rather than prudent risk management. This is what behavioral economists call taboo trade-offs. We are uncomfortable putting a price tag on things we consider sacred, like love or family. This psychological barrier prevented the product from reaching the critical mass needed to stabilize the risk pool. Furthermore, we must look at the wealth destruction data. When a household splits, you go from one mortgage to two, one utility bill to two, and one set of household goods to two. The potential outcomes of this split are almost always negative for both parties in the short term. Divorce insurance was designed to provide bridge capital to help cover the immediate costs of establishing a new household, paying for legal retainers, or covering moving expenses. It wasn't meant to make anyone rich, it was meant to prevent the feminization of poverty, a documented historical trend where women, who are statistically more likely to have taken career breaks for childcare, see a sharper decline in income post-divorce than men. From a regulatory standpoint, divorce insurance in the US hit a wall because state insurance commissioners struggled to categorize it. Was it casualty insurance? Was it life insurance? Because it didn't fit neatly into existing legal boxes, the potential outcomes for the company were bogged down in bureaucratic red tape. This lack of a clear legal framework meant that traditional giants like Geico or State Farm stayed far away from the concept, leaving it to small startups that lacked the capital reserves to survive long-term. We also need to consider the opportunity cost of not having this insurance. Without a formal insurance product, the American public has defaulted to the prenuptial agreement as a form of self-insurance. But prenups have their own behavioral hurdles. They require an adversarial negotiation before the marriage even begins. They are expensive, requiring two separate attorneys, and they often focus on protecting what you already have, rather than providing new liquidity when you need it most. Divorce insurance, in theory, was a no-fault solution that could have been purchased unilaterally by one spouse to protect their own future interests without needing the other spouse's permission or signature. As we move forward in this deep dive, we will analyze the loss aversion theory. In behavioral economics, the pain of losing something is twice as powerful as the joy of gaining something. Yet, we see a massive failure in the US population to apply loss aversion to their marital assets. We will explore how hyperbolic discounting, our tendency to choose smaller immediate rewards over larger later rewards, causes us to skip the $20 monthly premium today, even if it could save us $20,000 in legal fees 5 years from now. This is a masterclass in the intersection of the human heart and the cold, hard math of American finance. To understand the massive resistance to divorce insurance in the modern American economy, we have to look at the concept of information asymmetry. In the world of behavioral economics, information asymmetry occurs when one party in a transaction has more or better information than the other. Imagine a character named Michael in the year 2026. Michael is an upper-middle-class professional living in a high-cost-of-living city like Austin, Texas. He is about to get married to Chloe. On the surface, their relationship looks perfect. They share a love for high-yield savings accounts, weekend hiking, and their shared investment in a local bakery. However, Michael has a secret, or perhaps just a deep-seated intuition. He knows that his career requires intense travel, and that his last 2 long-term relationships ended because of his inability to maintain a presence at home. Michael has a piece of information that the insurance company does not. If Michael were to go out and buy a divorce insurance policy in 2026, he is doing so because he perceives a high probability of a payout. This is the heart of the adverse selection problem that has historically crushed this industry. In a standard insurance model such as auto insurance, the company uses historical trends and massive data sets to price risk. They know that a 20-year-old male driving a sports car in Los Angeles has a mathematically higher probability of an accident than a 50-year-old woman driving a sedan in rural Iowa. They price the premium accordingly. But divorce insurance faces a unique hurdle because the risk is often hidden within the private psychology of the couple. When an insurance company tries to price a policy for Michael and Chloe, they are looking at credit scores, employment history, and perhaps even demographic data. But they cannot look into the silent arguments at 2 a.m. or the fundamental incompatibilities that have not yet surfaced. Because of this, the only people who are traditionally motivated to seek out divorce insurance are those who suspect they will actually need it. This leads to a death spiral where the insurance pool is filled with high-risk individuals, forcing premiums to skyrocket, which then drives away the low-risk couples who would have balanced the pool. Historical trends show us that the United States has a very specific relationship with the economics of family. In the 1970s, the introduction of no-fault divorce laws across the country changed the risk landscape overnight. Before no-fault divorce, you typically had to prove some form of wrongdoing, such as adultery or abandonment, to legally end a marriage. This acted as a natural barrier to entry for the divorce market. Once those barriers were removed, the statistical likelihood of divorce increased, making it an even more difficult event to insure. In 2026, we see the echoes of this in how we handle prenuptial agreements. A prenup is essentially a form of self-insurance, but it requires Michael and Chloe to sit across from each other and negotiate the terms of their own potential demise. This triggers what behavioral economists call the endowment effect. We overvalue what we currently have, our love, our shared future, our combined assets, and the idea of negotiating them away feels like a loss. Case studies of early attempts at marriage insurance, such as those seen in the early 2010s, reveal the mechanical failures of these products. For example, the wedlock product utilized a system of units where each unit cost roughly $15 a month and provided a $1,250 payout. To prevent Michael from buying a policy today and divorcing tomorrow, they implemented a 48-month vesting period. Think about the psychology of Michael in 2026. He has to pay a monthly premium for 4 years before he is even eligible for a payout. In his mind, he is calculating the opportunity cost. If he takes that $15 a month and puts it into a diversified index fund, the potential outcomes might be better than a payout that only triggers if his marriage fails. This is known as hyperbolic discounting. We tend to prefer smaller, immediate rewards, like having an extra $15 for a streaming subscription today, over the much larger, delayed benefit of a financial safety net in the event of a divorce 5 years from now. Furthermore, we have to address the moral hazard. In behavioral economics, moral hazard is the risk that a party provided with insurance may behave in a way that is different from how they would behave if they were not insured. Let us look at Michael again. Suppose he has reached his 5th year of marriage, and his divorce insurance policy is now fully vested. The payout for his 10 units of coverage is $12,500. Things are getting difficult with Chloe. In a world without insurance, Michael might look at the $30,000 in legal fees and the cost of moving into a new apartment and decide that he and Chloe should try one more round of intensive marriage counseling. The high cost of divorce acts as a stabilizer for the marriage. However, if Michael knows that a check for $12,500 is waiting for him the moment the decree is signed, his incentive to work through the struggle might be subtly diminished. The insurance, intended to be a safety net, accidentally becomes an exit ramp. The complexity of underwriting a marriage in 2026 is also a major factor. When you insure a house against a fire, the house is a static object. When you insure a marriage, you are insuring a dynamic, evolving contract between two autonomous human beings. Insurance companies in the United States are governed by state-level regulations that require them to maintain significant capital reserves. To get a license to sell divorce insurance, a company would have to prove to a state insurance commissioner that they have a predictable way to measure the frequency and severity of losses. But how do you measure the frequency of a heartbreak? How do you predict the severity of a legal battle over a shared dog or a 401k plan? Because the variables are so subjective, most traditional insurers view the potential outcomes as too volatile to be profitable. We must also consider the role of social signaling. In the United States, we use our financial choices to signal our values to those around us. If Michael tells his friends he bought life insurance, they see him as a responsible provider. If he tells them he bought disability insurance, they see him as a prudent planner. But if Michael tells his friends at a dinner party in 2026 that he has purchased 10 units of divorce insurance, the social signal is entirely different. It signals a lack of confidence in his partner and his marriage. This social cost is a hidden tax on the product. Behavioral economists call this a taboo trade-off. We are often unwilling to trade social standing or moral clarity for financial security. This is why many people who would benefit from such a product never even consider it. They would rather risk financial ruin than face the social stigma of planning for it. Case studies from the United Kingdom and parts of Europe show that there have been similar struggles abroad, but the U.S. market is uniquely difficult due to our litigious culture. In the U.S., a divorce is not just a filing. It is a lawsuit. This means the severity of the loss is not just the loss of the partner, but the massive transfer of wealth to the legal profession. This makes the payout required to make the insurance meaningful much higher than in other countries. If an insurance payout only covers $2,000, it barely pays for a retainer. If it covers $50,000, the premiums become so high that only the wealthiest can afford them, and those people likely already have prenups or significant assets that make the insurance redundant. This brings us to a fascinating development in the shadow markets of 2026. While official divorce insurance remains a rarity, we are seeing the rise of hybrid financial products that function in a similar way without carrying the name. We are seeing alimony protection riders on certain types of life insurance and specialized trusts designed to trigger payouts upon a legal separation. These are the evolution of the divorce insurance concept, rebranded to bypass the psychological and regulatory barriers that destroyed the pioneers of the industry. We are beginning to see how the American financial system is trying to solve the divorce problem by hiding it inside other products, effectively tricking our own behavioral biases. As we peel back the layers of this economic puzzle, we have to ask a darker question. If the insurance companies can't price the risk of your marriage failing, who can? Is there a way to use modern big data and social media sentiment analysis to predict which marriages will survive and which will end in a claim? And if an algorithm could tell you with 80% accuracy that you will be divorced in 7 years, would you buy the insurance, or would you cancel the wedding? In the next part, we are going to look at the terrifying world of marital predictive analytics and how a new generation of startups is trying to use your digital footprint to underwrite your love life. We are moving from the history of failed products into the future of data-driven heartbreak. The transition from historical actuarial tables to the era of predictive analytics represents the most significant shift in the landscape of American behavioral economics since the invention of the credit score. In the year 2026, we are witnessing the emergence of what experts call the quantified relationship. To understand how a modern insurance entity would even begin to underwrite the risk of a divorce, we have to look at the massive trail of data that a modern couple like Sarah and Mark leaves behind. Sarah is a 34-year-old software engineer in Seattle, and Mark is a 36-year-old architect. They have been married for 3 years and are considering a high-value marital indemnity policy to protect their shared equity in a downtown condo. In the past, an insurance company would look at their ages, their income, and perhaps their location. In 2026, the underwriting process is an immersive dive into their digital footprints. This is where the concept of the digital breadcrumb comes into play. Behavioral economists have identified that our spending habits are often a more accurate reflection of our relationship health than anything we might say in a survey. For Sarah and Mark, the insurance company's algorithm might look at the frequency of shared versus individual transactions. Historical trends suggest that couples who maintain a high percentage of shared financial goals and transparent spending are statistically less likely to experience a sudden marital dissolution. If the data shows a sudden spike in individual, secretive spending, what economists call financial infidelity, the risk profile of that marriage changes instantly. The potential outcomes for their premium prices are directly tied to how their financial behaviors align with established models of marital stability. But it goes much deeper than just bank statements. We are now entering the realm of marital sentiment analysis. Imagine an underwriting process that requests access to a couple's communication metadata. In 2026, natural language processing can analyze the tone, frequency, and timing of digital interactions. Researchers like Dr. John Gottman famously identified the magic ratio of 5-to-1, meaning that for every one negative interaction, a stable marriage has 5 positive ones. In a data-driven insurance model, an algorithm could analyze years of anonymized communication to see if a couple is maintaining this ratio. If Sarah and Mark's digital interactions show a decline in positive sentiment or an increase in what psychologists call the 4 horsemen, criticism, contempt, defensiveness, and stonewalling, the insurance company views the marriage as a depreciating asset. This leads us to a fascinating and somewhat controversial concept in behavioral economics: the divorce contagion effect. Sociological data from the United States suggests that divorce can spread through social networks like a virus. If your immediate best friend gets a divorce, your own risk of divorce increases by a statistically significant margin. In 2026, an insurance underwriter might look at Sarah and Mark's social graph. If 3 of their closest shared friends have filed for divorce in the last 24 months, the potential outcomes for Sarah and Mark's marital stability are viewed through a more skeptical lens. The logic here is based on the idea of social norms. When divorce becomes common in a peer group, the perceived cost of the social stigma decreases, making it a more available option in the minds of the individuals. The challenge for the insurance industry is solving the problem of asymmetric information by turning the couple's life into a transparent data set. In traditional economics, if Sarah knows she is unhappy but hides it from the insurer, she has the advantage. By requiring access to high-fidelity behavioral data, the insurer levels the playing field. However, this creates a new behavioral phenomenon, the observer effect. If Sarah and Mark know that their marriage score and their insurance premiums are being determined by their digital behavior, they might begin to perform a healthy marriage rather than actually having one. They might send more positive texts or make more shared purchases simply to keep their premiums low. This is a classic example of Goodhart's law. When a measure becomes a target, it ceases to be a good measure. To counter this, 2026 startups are looking at even more objective data points, such as biometrics from wearable devices. Imagine a scenario where a couple's smartwatches track their physiological responses during an argument. High levels of flooding, a state where the heart rate exceeds 100 beats per minute during a conflict, are a leading indicator of marital breakdown. If an insurance company can see that a couple spends 3 nights a week in a state of physiological arousal and stress, the underwriting model will predict a much higher probability of a claim. The depth of this data allows for a level of risk pricing that was previously impossible, but it also raises profound questions about the commodification of intimacy. We must also examine the sunk cost fallacy within the context of these premiums. In behavioral economics, people are often reluctant to abandon a course of action if they have heavily invested in it, even if it is no longer in their best interest. If Sarah and Mark have paid $20,000 in divorce insurance premiums over a decade, they might feel a psychological pressure to stay in a failing marriage just to avoid wasting that investment. Alternatively, they might feel a pressure to divorce just to collect the payout if the policy is near its expiration or vesting peak. This is why the structure of the policy, the incentives and the disincentives, must be incredibly precise to avoid accidentally encouraging the very outcome the insurance is designed to mitigate. Let us look at a case study involving a fictionalized 2026 platform called Amity Mutual. Amity doesn't just sell insurance. They sell a marital wellness subscription. By paying a monthly fee, the couple gets a potential payout in the event of a divorce, but they also get access to discounted therapy, financial planning, and even stress-reducing travel vouchers. This is a behavioral nudge. By bundling the insurance with proactive maintenance tools, the company is trying to lower its own risk. They are moving from being a passive payer of claims to an active participant in the survival of the marriage. This is similar to how health insurance companies give you a discount for going to the gym. In the world of behavioral economics, this is known as a commitment device. Sarah and Mark are essentially paying the company to help them stay together, using the insurance payout as a worst-case scenario backup. The complexity of these data-driven models also creates a new form of inequality. What happens to the uninsurable couples? If the algorithms determine that a certain demographic or a certain set of personality traits are high risk, we could see a world where financial protection for the family unit is only available to those who already fit a very specific, stable, and perhaps privileged profile. This creates a feedback loop where those at the highest risk of the financial devastation of divorce are the ones least able to afford the protection against it. This is the dark side of behavioral underwriting in the United States. As we continue to explore this intersection of data and the heart, we have to look at the legal battlegrounds that are forming in 2026. Who owns this marital data? Can a spouse use the insurance company's own risk assessment as evidence in a custody battle? Can the data that was meant to protect you be turned against you in a court of law? In the next part, we are going to dive into the legal minefield of divorce insurance and how the American court system is struggling to keep up with the technology that claims to price the probability of love. We will look at the landmark cases where an insurance risk score became the star witness in a $1 million settlement. The intersection of contract law and marital dissolution in the year 2026 has created a legal landscape that few could have predicted a decade ago. We must look at the hypothetical but highly plausible case of David and Elena, a couple living in Florida, which serves as a landmark study for how the American court system handles the data generated by divorce insurance providers. David and Elena had been married for 12 years when they filed for divorce in 2026. Central to their legal battle was a high-value marital indemnity policy David had purchased 4 years prior without Elena's explicit knowledge. In the discovery phase of their divorce, Elena's attorney subpoenaed the records of the insurance carrier, seeking not just the policy details, but the entire underwriting file. This creates the first major legal hurdle: the admissibility of relationship risk scores. In 2026, the data points used to price David's premium included his location-based services, his sentiment analysis from private communications, and his individual spending patterns. Elena's legal team argued that the insurance company's internal risk score, which had labeled the marriage as high risk 18 months before the actual filing, was evidence of David's intent to abandon the marriage. They claimed this constituted a form of strategic planning that should influence the equitable distribution of their marital assets. The court was forced to decide if an algorithmic prediction generated by a third-party corporation could be used as a proxy for a spouse's state of mind or their commitment to the marital contract. From a behavioral economics perspective, this case highlights the conflict between the expectation of privacy and the transparency required for modern risk management. Historical trends in U.S. family law have traditionally focused on the conduct of the parties during the marriage. However, the introduction of predictive data shifts the focus to the anticipated future of the relationship. In the David and Elena case, the court had to grapple with the idea of a self-fulfilling prophecy. If David was paying a premium based on a high probability of divorce, did that financial commitment subconsciously or consciously drive his actions toward that outcome? This is the ultimate manifestation of moral hazard in a legal setting. The defense argued that the insurance policy was a private financial instrument, similar to a separate savings account or a disability policy, and should be excluded from the marital estate. However, in many U.S. states, premiums paid using marital income, even if the account is in only one spouse's name, can transform the resulting benefit into a marital asset. This means that in 2026, a payout from a divorce insurance policy might be subject to the very division it was meant to mitigate. Imagine the irony. You purchase insurance to protect your financial future in the event of a divorce, only for the court to order you to give half of that insurance payout to the person you are divorcing. This creates a recursive loop of wealth redistribution that can render the insurance practically useless for its intended purpose. Furthermore, we must analyze the doctrine of unconscionability. In contract law, a contract may be found unenforceable if it is so one-sided that it is unfair to one party. In 2026, legal scholars are debating whether divorce insurance policies that utilize deep data underwriting are inherently unconscionable. If the insurance company knows through its superior data processing that a marriage is 90% likely to fail, but they continue to collect premiums from a consumer who believes they have a 50-50 chance, is that a fair exchange? Or is it a form of predatory behavior? Behavioral economics teaches us that consumers are notoriously bad at assessing their own risks, and if companies use that cognitive bias to sell policies with almost no chance of a net positive outcome for the consumer, the legal system may eventually step in to regulate these products out of existence. We also have to consider the impact of these policies on alimony or spousal support. Historical trends in the U.S. show that alimony is often calculated based on the need of one spouse and the ability of the other to pay. If Elena receives a significant payout from a marital indemnity policy, a judge in 2026 might view that as a reduction in her financial need. Consequently, the presence of insurance could lead to a lower alimony award. This creates a complex incentive structure. For the higher-earning spouse, paying for insurance for their partner might be a strategic way to cap their future alimony liability. But for the lower-earning spouse, accepting an insurance-backed safety net might inadvertently mean they are trading away long-term, court-ordered support for a one-time, lump sum payment that may not cover their lifetime needs. The regulatory environment in the United States is currently a patchwork of conflicting rules. Each state's insurance commissioner has a different view on whether these products constitute insurance or gambling. In states that lean toward a gambling definition, the potential outcomes for companies are dire, as they can be hit with massive fines for operating an illegal lottery. The argument is that since the policyholder has a degree of control over the outcome, they can choose to file for divorce. The event is not truly accidental or fortuitous. This is the same reason you cannot buy insurance on a business you intend to burn down. However, proponents of the industry argue that while a person can choose to file for divorce, they cannot choose to fall out of love or prevent their spouse from leaving. In their view, the emotional and social dissolution of a marriage is a fortuitous event that is as unpredictable and devastating as a natural disaster. In 2026, we are also seeing the rise of the specialized divorce insurance auditor. These are professionals, often with dual backgrounds in forensic accounting and behavioral data science, who are hired by law firms to deconstruct the algorithms used by insurance companies. In the David and Elena case, an auditor was brought in to prove that the insurance company's data was biased. They argued that the algorithm penalized the couple for certain cultural spending habits that had no actual correlation with marital stability, but were misinterpreted by the model. This brings us to the issue of algorithmic fairness. If the tools used to price the risk of your marriage are based on flawed or biased data sets, the financial protection of the American family becomes a matter of digital luck, rather than actual risk. To truly understand the depth of this issue, we have to look at the step-by-step process of how a claim is settled in this new era. It is not as simple as showing a divorce decree. In 2026, the claims process for a high-value policy often involves a mandatory mediation period, where the insurance company attempts to reconcile the couple. This is a cost-saving measure for the insurer. If they can spend $5,000 on a world-class marriage retreat to avoid a $50,000 payout, they will do it every time. This introduces a third party into the most intimate parts of a relationship. The insurance company becomes a stakeholder in your marriage, with a financial incentive to keep you together, regardless of whether staying together is healthy for the individuals involved. Imagine if your insurance company had the power to deny your claim because you didn't attend enough counseling sessions, or because you didn't follow the specific behavioral nudges sent to your phone via their wellness app. This is the reality of the conditional payout. It transforms the concept of no-fault divorce back into a fault-based system, where the fault is determined not by a judge, but by the terms and conditions of a corporate contract. As we look toward the future, the question isn't just whether you can insure your marriage, but whether the act of insuring it fundamentally changes the nature of the institution itself. Are we moving toward a society where love is just another asset class to be hedged, leveraged, and audited? In the next part of this masterclass, we are going to explore the psychological impact of being a policyholder. We will look at the invisible weight of the waiting period, and how the countdown to a vested policy can create a divorce cliff that threatens the very stability it was meant to protect. We are going to look at why the year 2026 might be remembered as the year the American honeymoon was replaced by the American actuarial table. The phenomenon of the divorce cliff is perhaps the most striking example of how behavioral economics can fundamentally alter human decision-making within the domestic sphere. To grasp this, we must examine the specific mechanics of the vesting period used by marital indemnity providers in the United States. Historical trends in the insurance industry show that most risk mitigation products require a period of seasoning or waiting before a claim can be filed to prevent immediate exploitation of the policy. In the context of marriage insurance, this waiting period is typically set between 48 and 60 months. For a couple like James and Linda, living in suburban Ohio in the year 2026, this vesting period creates a psychological and financial gravity well that dictates the timing of their most intimate life choices. Imagine James and Linda purchased a standard marital indemnity policy in early 2022, shortly after their wedding. They have been paying a monthly premium of $75 for nearly 4 years. As they navigate the complexities of 2026, their relationship has reached a point of significant strain. However, they are currently at month 46 of their 48-month vesting period. If they were to file for legal separation today, the potential outcomes involve the total forfeiture of every dollar paid in premiums and zero payout from the policy. If they can manage to stay legally married for just 60 more days, they reach the cliff. At month 49, they become eligible for a high-value payout intended to cover their transition costs and legal fees. This creates a behavioral state known as artificial stability. From the perspective of an external observer or a traditional sociologist, James and Linda might appear to have a stable marriage because they have not filed for divorce. However, a behavioral economist sees a couple that is responding to a massive financial incentive to delay the inevitable. This is a form of temporal discounting where the value of future liquidity, the insurance payout, outweighs the immediate emotional cost of staying in a difficult situation. In the United States, where the cost of living and the price of legal services continue to rise in 2026, this 48-month mark becomes a statistical anomaly in divorce filings. We see a dip in filings at month 45 and a massive spike at month 50. The insurance policy has not saved the marriage, it has merely rescheduled the heartbreak. Furthermore, we have to look at the sunk cost fallacy as it applies to these long-term policyholders. James has spent over $3,000 in premiums over the last 4 years. Behavioral economics teaches us that humans are biologically wired to avoid feeling that an investment has been wasted. This creates a cognitive dissonance. James might feel that by divorcing before the policy vests, he is admitting to a double failure: the failure of his marriage and the failure of his financial strategy. This double loss aversion can keep people in high-conflict environments for months, or even years longer than they would otherwise stay. The insurance product, designed to provide a safety net for a transition, accidentally becomes a cage that keeps the parties locked in a state of marital purgatory. In 2026, the American insurance market has attempted to mitigate this by introducing stay marriage bonuses. This is a fascinating application of positive reinforcement. Instead of just a payout upon divorce, some policies offer a survival dividend every 5 years the couple stays together. For James and Linda, if they reach their 5-year anniversary without a claim, the insurance company might offer a choice: a cash dividend of $500 or a significant reduction in their future premiums. This shifts the framing of the product from a divorce policy to a marriage maintenance policy. However, the data from 2026 case studies suggests that these bonuses are often too small to change the long-term trajectory of a fundamentally incompatible couple. They act as a minor nudge in a situation that requires a major structural overhaul. We also need to consider the secret policy phenomenon. Because insurance in many U.S. jurisdictions can be purchased individually, we are seeing cases in 2026 where one spouse is unaware that the other is hedging against the relationship. Imagine if Linda has been secretly paying for a policy for years. She has been effectively pricing the risk of her marriage to James without his consent or knowledge. When they finally enter a lawyer's office, the revelation of this policy can act as a psychological hand grenade. The spouse who is unaware feels a profound sense of betrayal, as the existence of the policy proves that the other party has been contemplating the end for a long time. In the eyes of behavioral economics, this is a failure of transparency that leads to a complete breakdown of trust, often accelerating the very divorce the policy was meant to fund. To add another layer of depth, we must examine the role of the American actuarial table in the 2026 honeymoon period. Traditionally, the first few years of marriage are seen as a time of romantic optimism. But as divorce insurance becomes more normalized in the U.S. consciousness, we are seeing the rise of the actuarial honeymoon. Before the wedding, couples are now having deep-dive financial discussions not just about their bank accounts, but about their risk scores. They are looking at their combined data and asking, what is the probability that we make it to year 10? This objective, data-driven approach to romance is a radical departure from historical norms. It replaces the until death do us part ethos with an until the risk-adjusted return is no longer viable strategy. This shift has profound implications for how we view the institution of marriage itself. If every marriage in the United States in 2026 is viewed as a high-stakes financial contract with an associated insurance premium, the emotional labor of the relationship becomes a form of risk management. When James does the dishes or Linda listens to James talk about his day, they aren't just performing acts of love. They are maintaining their marital asset to keep their insurance premiums low and their payout potential high. This commodification of affection is the ultimate frontier of behavioral economics. We are seeing the quantification of the human heart in real time. In 2026, we are also seeing the emergence of secondary markets for these risks. Just as life insurance policies can be sold to third-party investors in a process known as a life settlement, there are whispers on Wall Street about the creation of divorce settlements. Investors might buy the rights to a person's future divorce insurance payout in exchange for immediate cash. This would mean that a stranger in a skyscraper in New York could literally be betting on the failure of a marriage in Ohio. This takes the concept of moral hazard to a global scale. If the financial system is set up to profit from the dissolution of the American family, the incentives for social stability are fundamentally compromised. As we conclude this exploration of the psychological and actuarial impact of these policies, we must prepare for the next step in our investigation. The insurance company isn't just a silent observer of your marriage. In 2026, they are becoming an active participant. They are using AI-driven nudges to tell you when to go on a date, what to say during an argument, and even when to seek medical intervention for stress. But what happens when the insurance company decides that your marriage is a lost cause? What happens when the algorithm decides that it is cheaper to pay out your claim now than to continue insuring you for another 10 years? In the next part, we are going to look at the rise of the forced settlement and the terrifying power of the algorithmic nudge that tells you when it's time to give up. We are entering the world of corporate-mandated heartbreak. In the year 2026, the intersection of human emotion and machine learning has reached a point of saturation, moving beyond mere observation into the realm of active intervention. We see this most clearly in the development of the preemptive dissolution offer, a financial mechanism that is currently being tested by several high-tech insurance carriers across the United States. To illustrate the profound behavioral impact of this, let us look at the case study of Marcus, a 38-year-old middle manager in Chicago, and Brenda, a 40-year-old healthcare consultant. They have been married for 7 years and have held a high-tier marital indemnity policy with a prominent U.S. carrier since 2023. Their policy, much like a complex derivative in the financial markets, is designed to hedge against the total loss of household equity. By 2026, their insurance provider has access to a staggering amount of data. The provider is not just looking at their tax returns. It is monitoring the digital pulse of their home. This includes everything from the frequency of shared calendar invites to the tone of their voice during interactions captured by smart home devices. In early 2026, Marcus and Brenda began receiving what are known as efficiency nudges on their shared marital dashboard. These are not explicitly about divorce. Instead, they are subtle suggestions. Perhaps you should try this specific weekend getaway, or here is a discount for a conflict resolution workshop. However, behind the scenes, the insurance company's algorithm has already flagged their marriage as being in the red zone. Historical trends in marital data suggest that when communication drops by 60% and individual spending increases by 25% simultaneously, the probability of a total marital collapse within 18 months exceeds 80%. This is where the concept of corporate-mandated heartbreak enters the equation through the mechanism of choice architecture. In behavioral economics, choice architecture is the design of different ways in which choices can be presented to consumers and how that presentation influences decision-making. For Marcus and Brenda, the insurance company decided to move from a maintenance nudge to a liquidation offer. One morning, instead of a coupon for a romantic dinner, they received a notification titled Mutual Liquidation Option. The offer was simple. If they agreed to a legal dissolution of their marriage within the next 90 days, the insurance company would pay them a $40,000 settlement immediately. From the insurer's perspective, this is a rational loss mitigation strategy. The company knows that if Marcus and Brenda stay in a high-conflict marriage for another 2 years, the final divorce will likely be a scorched earth legal battle. The potential outcomes of a high-conflict divorce include massive legal fees that the insurance company would have to indemnify, potentially reaching upwards of $100,000. By offering a smaller, immediate settlement of $40,000, the insurance company is essentially buying its way out of a much larger future liability. They are betting that Marcus and Brenda will succumb to the present bias, which is our tendency to overvalue immediate rewards over future benefits. For Marcus and Brenda, this offer creates a terrifying psychological paradox. They were not necessarily planning to divorce that day, but the presence of the $40,000 offer serves as an anchor. In behavioral economics, anchoring is a cognitive bias where an individual relies too heavily on an initial piece of information offered. Suddenly, the value of their marriage is no longer an abstract emotional concept. It has a concrete, corporate-stamped price tag of $40,000. They begin to look at each other through the lens of a failing investment. Every argument they have now carries a literal cost. They think to themselves, if we stay together and fight, we are losing $40,000 of guaranteed liquidity that could help us both start over. This is the algorithmic nudge that tells you when it is time to give up. This leads us to a deeper analysis of the efficiency of exit. In the United States of 2026, we are seeing a shift in the cultural narrative surrounding divorce. It is no longer viewed solely as a moral or emotional failure, but as a financial reorganization. The insurance companies are driving this narrative by framing early dissolution as the most efficient outcome for all parties involved. This is a direct application of the Coase theorem from economics, which suggests that if trade in an externality is possible, and there are sufficiently low transaction costs, bargaining will lead to an efficient outcome regardless of the initial allocation of property. The insurance company is essentially facilitating a bargain between two unhappy people to reach an efficient financial exit before they destroy their remaining marital wealth in the court system. However, the step-by-step reality of these settlements is fraught with ethical landmines. Let us look at how the process unfolds in 2026. Step 1 is the automated risk notification. where the couple is informed that their policy premiums will increase by 50% due to their high-risk behavioral patterns. This is the stick. Step 2 is the settlement incentive, which is the $40,000 offer. This is the carrot. Step 3 is the cooling-off period, a mandatory 30-day window where the couple must consult with a court-appointed or company-provided financial mediator. But here is the catch. The mediator is often incentivized by the insurance company to facilitate the settlement. This creates a massive conflict of interest where the person supposed to help you save your marriage may actually be working for the entity that wants you to end it. In 2026, we are also seeing the emergence of the digital pre-settlement. This is a clause in some high-tech insurance contracts where the couple pre-agrees to an algorithmic division of assets if the marriage score falls below a certain threshold. For Marcus and Brenda, this meant that their smart contracts were already programmed to liquidate their shared investment accounts and divide the proceeds 60-40 based on their relative income contributions the moment they both clicked accept on the settlement offer. There were no lawyers, no judges, and no courtroom drama. Just a series of digital signatures that ended a decade of companionship in less than 15 minutes. This is what we call frictionless heartbreak. The behavioral impact of this frictionless exit cannot be overstated. When the barriers to ending a marriage are removed, and a financial reward is added, the very nature of commitment changes. We move from a world of resilient love to a world of liquid love. Case studies from early 2026 suggest that couples who take these preemptive settlements often experience a specific type of psychological trauma, known as actuarial regret. This occurs when an individual realizes they made a life-altering emotional decision based on a temporary financial nudge. Marcus and Brenda might find themselves 6 months later, $40,000 richer but deeply mourning a relationship that might have survived if a corporation hadn't placed a bounty on its head. We must also examine the data-driven manipulation of social norms. As more couples in 2026 accept these settlements, the act of staying in a difficult marriage begins to be viewed as financially irresponsible. The insurance companies use their massive marketing budgets to highlight stories of people who took the settlement and moved on to happier lives. They are effectively rebranding divorce as a smart financial pivot. This is an example of social proof, where people look to the behavior of others to determine their own actions. If the algorithm says your marriage is over, and your neighbors took the payout, you are statistically more likely to follow suit. As we look toward the final parts of this masterclass, we have to ask, if the insurance companies have perfected the art of ending marriages, what happens to the most vulnerable members of the family unit? How does an algorithm decide the value of a child's time, or the cost of a parent's absence? In the next part, we are going to dive into the chilling world of algorithmic custody and child support. We will see how 2026 insurance providers are using AI to predict which parent will provide the best return on investment for a child's future, and how these predictions are being used to automate the most heartbreaking decisions a human being can make. We are moving from the liquidation of the couple to the optimization of the child. To understand the transition from the liquidation of the couple to the optimization of the child, we must examine the human capital theory as applied to family law in the United States. In the year 2026, many high-end divorce insurance policies have evolved to include what is known as a child success rider. This is not merely a financial safety net for the parents. It is a complex risk management tool that treats the child's future stability as a hedgeable asset. Let us look at the case study of Alex and Jordan, a couple in Denver, Colorado, and their 8-year-old son Leo. Alex and Jordan are in the final stages of a 2026 mediated divorce, and their insurance provider, a firm specializing in behavioral underwriting, is now the primary architect of their custody arrangement. In traditional American family law, the standard has always been the best interests of the child. However, this legal standard is notoriously subjective and often leads to prolonged, expensive litigation. In 2026, the insurance model replaces this subjectivity with algorithmic optimization. The insurance company's goal is to minimize the probability of a future claim. Historical trends indicate that children of high-conflict divorces are statistically more likely to experience lower academic performance, increased healthcare costs, and higher rates of behavioral issues, all of which represent financial liabilities for a comprehensive family insurance policy. To mitigate these risks, the algorithm analyzes Leo's digital footprint, including his school attendance records, his biometric data from his fitness tracker, and his cognitive performance on educational apps. The algorithm then produces what is known as a stability projection. For Alex and Jordan, The algorithm determined that a strictly 50-50 physical custody split was not the optimal outcome. Why? Because the data showed that Leo's cortisol levels, measured via his wearable device, spiked significantly every Sunday evening during the transition between houses. Furthermore, his academic performance in mathematics showed a direct correlation with the weeks he spent at Jordan's house, which was closer to a high-performing tutoring center. In response, the insurance company presented a data-driven custody plan, 60-40 custody in favor of Jordan, with a mandatory stability bonus paid to Alex if he moved within a 3-mile radius of Jordan's residence. This is a classic application of incentive alignment. The insurance company isn't just telling Alex where to live. They are using a financial nudge to align his personal choices with the child's statistical success. If Alex accepts the move, his individual premiums drop, and the child support fund, managed by the insurer, increases. This transforms child support from a static monthly payment into a dynamic support fund. In the United States of 2026, instead of Jordan receiving a fixed check from Alex, the insurance company manages a digital wallet. The funds in this wallet are released based on performance milestones. For example, if Leo maintains a specific grade point average or completes a series of mental health check-ins, the fund releases additional capital for extracurricular activities. This creates a behavioral phenomenon known as outcome-based parenting. Alex and Jordan are no longer just parents. They are co-managers of Leo's human capital. The potential outcomes of this system are fascinating. On one hand, it reduces the need for constant litigation. There is no need to go back to court to argue about soccer camp fees, if the algorithm has already approved the expenditure based on Leo's physical activity data. On the other hand, it introduces a level of surveillance that can be stifling. If Jordan spends child support funds on something the algorithm deems a low-value asset, for example, high-sugar snacks instead of organic produce, the system may flag the transaction and reduce the next month's disbursement. This is the ultimate expression of choice architecture, where the insurer designs the environment to favor specific, data-backed parenting decisions. The economics of this are rooted in rational choice theory. The insurer assumes that Alex and Jordan will act in their own financial self-interest. By making the child's well-being a financial metric, the insurer forces the parents to cooperate. If they engage in high-conflict behavior such as disparaging each other in front of the child, and this is captured by the sentiment analysis on their smart home devices, the algorithm triggers a conflict penalty. Their insurance premiums spike, and their eligibility for the stay marriage or co-parenting bonuses is revoked. In 2026, we see that the financial cost of a heated argument can be precisely calculated in real time, acting as a powerful deterrent to the emotional volatility that typically characterizes American divorces. However, we must also look at the step-by-step reality of how this optimization can go wrong. Consider the concept of algorithmic bias in custody. If the insurer's dataset is primarily trained on high-income, suburban families, the algorithm may unfairly penalize a parent who lives in a diverse urban environment or works non-traditional hours. For a parent like Alex who might work a night shift in 2026, the algorithm might view his schedule as a risk factor for Leo's sleep hygiene, regardless of the quality of the time they spend together. This leads to a situation where the insurance company is effectively social engineering the American family to fit a very narrow definition of stability. Furthermore, we encounter the problem of gaming the system. Behavioral economics tells us that when a measure becomes a target, people will find ways to manipulate it. If Alex and Jordan know that Leo's GPA influences their insurance payouts, they might pressure him to take easier classes or hire coaches specifically to boost the metrics the algorithm monitors. This is known as Campbell's Law. The more any quantitative social indicator is used for social decision-making, the more subject it will be to corruption pressures, and the more apt it will be to distort and corrupt the social processes it is intended to monitor. The optimization of the child becomes the exploitation of the child for the financial benefit of the parents and the insurer. In 2026, we are also seeing the rise of the secondary custody market. Some specialized hedge funds are beginning to offer to buy the future rights to a child's performance bonuses. They provide the parents with a lump sum today in exchange for a percentage of the child support fund's performance-based payouts over the next decade. This turns the American child into a literal investment vehicle, where their GRA, their health and their career trajectory are traded as commodities. This is the dark apex of behavioral economics, the complete financialization of the human life cycle. As we look at the results of these 2026 case studies, we see a paradox. The families who use these insurance-driven custody models often report lower levels of overt conflict, but they also report a sense of emotional sterility. Their lives are optimized, but they are also managed by a cold, unfeeling logic that doesn't account for the messy, unquantifiable beauty of family life. But what happens when the child grows up? What happens when Leo turns 18 and realizes that his entire childhood was a series of data points optimized for an insurance company's bottom line? In the next part, we are going to explore the concept of the marital exit tax and the massive wealth transfers that occur when a policy finally matures. We will look at how the U.S. government is beginning to eye these insurance payouts as a new source of tax revenue. We are moving from the optimization of the child to the final liquidation of the family estate. The year 2026 marks a pivotal turning point in American fiscal policy, as the Internal Revenue Service and the United States Treasury have begun to scrutinize the massive flows of capital originating from marital indemnity settlements. To understand the gravity of this shift, we must look at the case study of Vanessa, a 42-year-old marketing executive in New York City. Vanessa recently finalized her divorce from her husband of 15 years, Tyler. Because they had maintained a high-value divorce insurance policy since 2020, Vanessa was entitled to a settlement payout of $175,000 upon the entry of the final decree. However, as she prepared her 2026 tax filings, she encountered a phenomenon that behavioral economists are calling the marital exit tax. Historically, the tax treatment of insurance proceeds in the United States has been relatively straightforward. Life insurance payouts are typically tax-free to the beneficiary, and disability insurance is often tax-free if the premiums were paid with after-tax dollars. However, divorce insurance falls into a gray area of the 2026 tax code. The IRS has begun to argue that because divorce is a voluntary act in many jurisdictions, a payout for a divorce is not a recovery of a loss, but a realization of a financial gain. For Vanessa, this meant the IRS initially classified her $175,000 settlement as ordinary income, potentially subjecting her to a top marginal tax rate that would strip away nearly 40% of her safety net. This creates a massive behavioral hurdle known as the tax salience effect. In behavioral economics, tax salience refers to how noticeable a tax is to the person paying it. If the government takes 40% of a divorce settlement, the perceived value of that insurance policy drops instantly. Vanessa, who had relied on that full amount to secure a new apartment in Manhattan and cover her children's private school tuition, suddenly found herself in a state of financial panic. The government's intervention effectively changed the math of her divorce. What was meant to be a smooth transition became a high-stakes negotiation with the state. To understand the step-by-step mechanics of this 2026 fiscal struggle, we have to look at how Vanessa's legal team attempted to reclassify the payout. Step 1 involved the characterization of the premium payments. Because Vanessa had paid the premiums using her individual post-tax salary, her attorneys argued that the payout should be treated as a return of capital. Step 2 required a forensic audit of the insurance contract itself. They had to prove that the settlement was intended to indemnify her for specific economic losses, such as the loss of Tyler's future earning potential or the liquidation of their shared retirement accounts, rather than being a simple windfall. This leads us to the broader economic concept of the social safety net substitution. In the year 2026, the U.S. government is facing a massive budget deficit, partly due to the rising costs of social services for single-parent households. Behavioral economists at the Treasury Department have realized that divorce insurance actually acts as a private sector alternative to public assistance. If Vanessa has $175,000 in the bank, she is less likely to require government-subsidized housing or child care vouchers. By taxing these payouts, the government is effectively cannibalizing the very private safety nets that reduce the burden on the public purse. This is a classic example of a short-term fiscal gain, leading to a long-term social liability. Furthermore, we must analyze the rise of the Federal Marital Oversight Commission, a hypothetical but increasingly discussed agency in 2026. This commission's role would be to track the wealth transfers that occur during insured divorces to ensure that assets are not being hidden within insurance payouts to avoid capital gains taxes. For Tyler and Vanessa, this meant that their insurance carrier was required to issue a 1099 DIVR form, a new 2026 tax document that tracks the dissolution of insured marital estates. This document effectively acts as a red flag for the IRS, triggering an automatic audit of any divorce where a payout exceeds a specific threshold. The behavioral impact of this tax threat is profound. we are seeing the emergence of tax-induced marital retention. In 2026, many couples who are covered by high-value policies are choosing to stay in functional separations rather than legal divorces simply to avoid the tax hit of the insurance payout. They live in separate homes, they date other people, but they remain legally married to keep the insurance policy in a latent state. This creates a ghost market of marriages that exist only on paper for the purpose of tax and insurance optimization. From a sociological perspective, the tax code is accidentally encouraging a new form of the open marriage model, driven entirely by fiscal loss aversion. Case studies from 2026 indicate that the IRS is also targeting the stay marriage bonuses we discussed in previous parts. If Vanessa and Tyler had received a $5,000 bonus for reaching their 15th anniversary, the IRS now classifies that as a taxable incentive, much like a corporate bonus. This means the government is now a silent partner in the celebration of every marital milestone. This intrusion of the tax state into the domestic sphere has led to a massive pushback from privacy advocates, who argue that the government has no right to profit from the longevity or the failure of a private relationship. As we look at the macroeconomic data, we see that the total value of the divorce insurance market in the U.S. has reached a staggering $50 billion in 2026. This is a significant pool of capital that the government cannot ignore. We are seeing the introduction of the marital liquidation surcharge, a 2% tax on any insured settlement intended to fund state-run family counseling services. This is a form of Pigovian tax, a tax intended to discourage a behavior that has negative social externalities. By taxing the exit, the government is trying to subtly nudge people back toward the stability of the traditional family unit. However, the potential outcomes of these taxes are often the opposite of what is intended. By making it more expensive to leave a marriage, the government may be trapped in a situation where they are forcing people to stay in high-conflict, unproductive households, which lowers the overall economic productivity of the country. A person who is stressed and unhappy at home is statistically less productive at work. Thus, the marital exit tax may actually be a drag on the American GDP. In 2026, we also see the development of the offshore marriage trust. Wealthy Americans are now looking to move their divorce insurance policies to jurisdictions like the Cayman Islands or Bermuda to bypass the U.S. marital exit tax. This has created a new class of financial refugees, couples who literally move their legal marriage status to an offshore entity to protect their eventual dissolution payout. This is the ultimate expression of the globalized, financialized family. Love may be local, but the risk management of that love is now international. As we conclude this deep dive into the fiscal liquidation of the American estate, we have to look beyond the numbers and the tax forms. We have to look at the cultural soul of the country. What happens to a society when its most fundamental unit, the family, is governed by the same tax and insurance logic as a corporate merger? In the next part, we are going to explore the social and cultural aftermath of the insured divorce. We will look at the rise of the divorce party industry and how the insurance payouts of 2026 are fueling a new economy of celebratory dissolution. We are moving from the cold math of the IRS to the high-energy, high-stakes world of the post-marital rebrand. The insurance check has cleared. Now it's time to spend it. The injection of significant liquidity into the immediate aftermath of a marital dissolution has birthed an entirely new economic sector in the United States of 2026. Historically, divorce was a period of forced austerity, where both parties scrambled to minimize losses while downsizing their lifestyles. However, with the maturation of high-value divorce insurance policies, the transition period has been transformed into a moment of aggressive reinvestment in the self. This is a behavioral shift driven by signaling theory. In economics, signaling is the idea that one party credibly conveys some information about itself to another party. For Vanessa, whom we discussed in the previous part, the $175,000 insurance check serves as a powerful signal to the social and professional market that she is not a victim of a failed marriage, but a resilient and well-capitalized individual entering a new phase of productivity. In 2026, we see the rise of the post-marital rebrand agency. These are specialized consulting firms that cater specifically to newly divorced individuals who have just received an insurance payout. Let us look at the step-by-step process of how Vanessa might utilize her funds through one of these agencies. Step 1 is the digital erasure and curation. For a fee, data scientists use automated tools to scrub or archive 10 years of shared digital history across social media and public records, effectively resetting Vanessa's public-facing persona. Step 2 is the aesthetic pivot. This is not just about a new wardrobe. It involves high-level consultations on physical presence, public speaking, and even professional networking strategies designed to reposition the individual in the labor market. Historically, trends suggested that divorced women faced a penalty in the workplace. In 2026, the insurance-backed rebrand seeks to turn that narrative into a resilience premium. This leads us to the fascinating behavioral concept of conspicuous consumption as a form of emotional recovery. When Vanessa spends $20,000 on a high-profile Fresh Start gala at a luxury hotel in Manhattan, she is engaging in what economists call a Veblen good behavior. The value of the party is not just in the celebration itself, but in the price tag associated with it. By visibly spending her insurance payout, she is signaling to her social circle that her net worth remains intact despite the dissolution of her household. The insurance company, oddly enough, often encourages this. Some 2026 policies include social reintegration credits, which provide extra funds specifically for networking and professional development, under the theory that a socially and professionally successful divorcee is less likely to suffer from the long-term mental health issues that could lead to secondary insurance claims. We must also analyze the emergence of the divorce party industry as a legitimate subsector of the U.S. event planning market. In 2026, the potential outcomes for these events have moved far beyond simple gatherings. We are seeing dissolution destinations, all-inclusive travel packages where the insurance check covers a week-long retreat for the divorcee and 10 of their closest friends. The goal is to replace the trauma of the moving day with a high-dopamine social experience. From a behavioral perspective, this is an attempt at hedonic adaptation. By flooding the system with positive experiences immediately following the negative event of the divorce, the individual attempts to reset their baseline happiness level more quickly than they would through traditional grieving processes. However, there is a significant risk here known as the liquidity trap of heartbreak. Vanessa has $175,000 today, but she no longer has a dual-income household to support her long-term retirement. Behavioral economics warns us about the windfall effect, where people tend to spend found money, like an insurance payout, much more frivolously than they spend earned income. If Vanessa spends 60% of her payout on a rebrand and a world tour in the first 6 months of 2026, she may find herself in a precarious financial position by 2027. This is the dark side of the celebratory dissolution. The insurance payout provides the illusion of infinite wealth at a time when the individual is most emotionally vulnerable and least likely to make prudent long-term financial decisions. Case studies from 2026 indicate that insurance companies are starting to offer annuity options for divorce settlements to counter this behavioral bias. Instead of a lump sum, Vanessa could choose to receive her $175,000 over 5 years in monthly installments. This is a form of soft paternalism, where the insurer nudges the consumer toward a safer financial path. But the data shows that most Americans still choose the lump sum. The immediate emotional need to fix their life through spending outweighs the rational need for long-term stability. This is a classic example of present bias, where the immediate relief of a shopping spree or a luxury renovation feels more valuable than the abstract security of a pension in 2040. We also have to consider the second-time underwriting problem. In the year 2026, once Vanessa has used her divorce insurance policy, she becomes a known risk to the industry. If she decides to marry again in 2028, her premiums for a new marital indemnity policy will be significantly higher. Historical trends in the insurance industry show that once you have filed a claim for a specific type of loss, your perceived probability of a future loss increases. This creates a marriage penalty for the second act. The insurance company will look at the data from her first divorce. Was it high conflict? Did she take a settlement offer? Did she spend the money on a rebrand or an investment? All of these behavioral markers will be used to price the risk of her next relationship. This creates a new form of social stratification. In 2026, a premier divorcee like Vanessa, who managed her exit with grace and financial savvy, might be seen as a more desirable partner because she is vetted by the insurance system. Conversely, someone who had their policy canceled or who blew through their payout might be seen as uninsurable in the romantic market. We are literally seeing the creation of a credit score for love, where your history with an insurance carrier dictates your future romantic opportunities. The behavioral impact of this is that people in 2026 are beginning to treat their divorces like a corporate performance review, knowing that every move they make is being recorded in their permanent actuarial file. Furthermore, we must look at the impact on the legal profession. In 2026, Many family law attorneys in the U.S. have rebranded themselves as dissolution architects. They no longer just fight for assets. They help clients coordinate their insurance payouts with their post-marital rebrand. The lawyer's role has expanded to include lifestyle integration, where they work alongside the rebrand agencies to ensure that the legal settlement and the insurance payout are maximized for the client's new act. This is a high-stakes world where the legal decree is just the starting gun for a massive economic reconfiguration of the individual's life. As we stand in the year 2026, witnessing the final stages of the celebratory dissolution, we realize that the insurance check hasn't just paid for a divorce, it has bought a new identity. But identities, like any asset, require maintenance. What happens when the money runs out? What happens when the rebranded life faces the same mundane pressures that broke the first marriage? In the final part of this deep dive masterclass, we are going to look at the long-tail reality. We will examine the data on second marriage success rates for insured versus uninsured individuals and ask the ultimate question: has all this behavioral engineering actually made us any happier? Or have we simply created a more efficient way to be miserable? We are moving to the final conclusion of the American actuarial dream. To analyze whether this behavioral engineering has actually made us any happier, we must look at the 2026 longitudinal study of insured dissolution, a comprehensive dataset that followed 5,000 individuals through the 5-year period following their insurance-backed divorces. The results of this study have sent shockwaves through the American psychological and economic communities. While the short-term potential outcomes for these individuals included higher levels of financial security and lower immediate stress, the long-term data points to a phenomenon known as the resilience paradox. Historically, humans have built emotional resilience through the necessity of navigating hardship. By automating the transition and cushioning the fall with a 6-figure check, the insurance industry may have inadvertently stunted the emotional growth that typically follows a major life crisis. Consider the case of Robert, a 45-year-old architect in Chicago, who finalized his insured divorce in early 2024. By 2026, Robert is living what the algorithms would define as an optimized life. He utilized his $120,000 payout to clear his debts, secure a modern high-rise apartment, and hire a top-tier post-marital rebrand agency. On paper, his recovery was flawless. However, when Robert entered a new relationship in 2025, his behavioral patterns were fundamentally altered by his previous experience with the insurance system. He found himself constantly monitoring his new partner's digital sentiment, subconsciously checking for the red flags that had once triggered his previous insurance nudges. This is what behavioral economists call residual surveillance stress. Even without an active policy, Robert had been conditioned to view intimacy as a series of risk factors to be managed rather than a connection to be nurtured. This leads us to the 2026 Second Marriage Stability Index. Historical trends in the United States have always shown that second marriages have a higher rate of failure than first marriages, often hovering around 60 to 65%. However, for individuals who utilized a divorce insurance payout in their first marriage, the failure rate for their second marriage in 2026 is trending nearly 15% higher than the national average. Behavioral economists attribute this to the erosion of the commitment threshold. When a person knows through lived experience that a divorce can be a well-funded and professionally managed transition, the psychological cost of walking away from a subsequent relationship is significantly lowered. The insurance didn't just hedge the risk, it commodified the exit. We must also examine the impact on the American housing market and the broader economy. In 2026, the influx of insurance-driven liquidity has created a specialized real estate micromarket known as the transition tier. These are high-end, short-term luxury rentals specifically marketed to newly divorced individuals waiting for their insurance checks to clear or their rebrand to take effect. While this has provided a boost to the rental economy in cities like Austin, Seattle, and Miami, it has also contributed to a fragmentation of the traditional family neighborhood. We are seeing a shift in U.S. urban planning where the family unit is no longer the primary anchor of the community, replaced by a more fluid, individualistic model of living that is supported by a constant cycle of insurance premiums and payouts. The step-by-step reality of this new economy is visible in how the American legal system has finally adapted to the permanence of these products. By late 2026, several U.S. states have introduced the Marital Risk Disclosure Act. This law requires individuals to disclose the existence of any divorce insurance policies to a prospective spouse before a marriage license can be issued. This is a direct application of the principle of full disclosure in contract law. The government has realized that an insurance policy is a material fact that can influence the behavior of both parties. If a character like Robert hides his policy from a new partner, he is effectively engaging in a form of financial asymmetry that the law now seeks to prevent. As we look at the final philosophical synthesis of this masterclass, we have to address the actuarial dream versus the human reality. The dream of the 2020s was that we could use behavioral economics to solve the messiness of the human heart. We thought that if we could price the risk, we could eliminate the pain. But as we stand in 2026, the data suggests that while we have made divorce more efficient, we have not necessarily made it more meaningful or less damaging to the social fabric. We have created a system of liquid love, where relationships are treated as temporary assets to be hedged. The potential outcomes of this shift are still unfolding, but many sociologists warn that we are losing the social glue that comes from the shared struggle of building a life together without a corporate safety net. Let us look at a final scenario involving the character of Sarah from our earlier parts. In 2026, Sarah is considering a second marriage. She is sitting across from a financial advisor, looking at a screen that displays her relationship credit score. The score is high because she managed her first divorce with clinical efficiency, but the advisor notes that her premium for a new policy will be double what she paid before. Sarah faces a choice. Does she pay for the certainty of a protected exit, or does she choose to enter the marriage without a hedge, embracing the inherent risk that once defined the American family? This is the ultimate choice architecture of the modern era. By offering a safety net, we have made the act of truly jumping into a commitment feel like a form of financial recklessness. The history of divorce insurance in the United States will likely be remembered as the moment we tried to insurance-proof the soul. We have seen how case studies of companies like Safeguard paved the way for the data-driven giants of 2026. We have explored the legal minefields, the tax implications, and the algorithmic custody battles that have redefined parenthood. We have analyzed how the sunk cost fallacy and hyperbolic discounting drive our decisions to stay or go. But at the end of this deep dive, the fundamental lesson of behavioral economics remains. Humans do not always act in their own best interest, and even when they do, the interest of the individual often conflicts with the interest of the community. The American actuarial dream is a world where every loss is compensated, and every risk is mitigated. But in such a world, what is the value of a promise? If "until death do us part" is replaced by "until the vesting period is complete," the nature of the promise itself changes. It becomes a transaction. As we move beyond 2026, the challenge for the American public will be to find a balance between the prudent risk management offered by these financial products and the raw, unquantifiable commitment required to build a lasting society. We have built the most efficient divorce system in human history. Now, we must ask ourselves if we have forgotten how to build a marriage. Thank you for joining this 10-part masterclass on the behavioral economics of divorce insurance in the United States. We have traveled from the early days of wedlock to the algorithmic frontiers of 2026. If you have found this deep dive valuable, the investigation into the financialization of human life does not end here. The data is still coming in and the models are still being refined. The question is no longer whether your marriage can be insured, but what happens to you once the policy is in place. As the sun sets on the era of the unhedged family, we are left to wonder what other parts of the human experience are currently being priced, underwritten, and prepared for liquidation. The next evolution of the American economy is already beginning, and it is looking directly at the one thing we thought was truly priceless: